The job description of a credit manager centers on overseeing an organization's credit granting process and ensuring that the company maintains a healthy balance between sales growth and credit risk. Credit managers play a crucial role in maintaining a firm's financial health by assessing the creditworthiness of customers, approving or rejecting credit applications, setting credit limits, and enforcing payment terms. Their goal is to support sales while minimizing exposure to bad debt and ensuring timely collections. Credit managers are vital in industries where goods or services are sold on credit. These include manufacturing, wholesale distribution, retail, financial services, telecommunications, and construction. Whether working for a bank, a leasing company, or a corporate entity, credit managers make risk-based decisions that affect cash flow, working capital, and overall profitability. They analyze customer data, interpret credit reports, and work closely with sales teams, accounting departments, and external credit bureaus to manage credit policies effectively. This role requires a balance of financial acumen, analytical thinking, negotiation skills, and assertiveness. A credit manager must make sound judgments about extending credit while maintaining positive relationships with clients and ensuring that receivables are collected on time. In today's increasingly digital business landscape, credit managers also leverage automated systems, credit scoring models, and real-time analytics to streamline operations and make data-informed decisions. Primary responsibilities of a credit manager. A credit manager's responsibilities begin with assessing the creditworthiness of potential and existing customers. This involves analyzing financial statements, reviewing credit scores, checking trade references, and evaluating payment histories. In some cases, credit managers may also perform on-site visits or interviews with clients to better understand their financial health and operational stability. Once a customer's credit profile is assessed, the credit manager determines whether to approve or deny the credit application and sets the appropriate credit limit and payment terms. These decisions must align with the company's risk tolerance, industry standards, and internal credit policies. In doing so, credit managers must balance the need for revenue generation with the risk of non-payment. Monitoring existing accounts is a continuous responsibility. Credit managers regularly review aging reports to identify overdue invoices or high-risk accounts. They work closely with collections teams to follow up on late payments, negotiate repayment schedules, or escalate delinquencies to legal channels if necessary. At times, they may place accounts on credit hold, temporarily suspending future orders until payment is made. Another key responsibility is policy development. Credit managers often help draft or revise the organization's credit policies and procedures. They define risk categories, set limits for credit exposure, and establish guidelines for collections and write-offs. By creating clear frameworks, credit managers ensure consistency and compliance across departments and regions. Credit managers also play a role in strategic planning. They provide insights to senior leadership on credit risk trends, customer performance, and potential financial exposure. This information is crucial for managing liquidity, budgeting, and forecasting. In multinational companies, credit managers may also oversee country-specific credit regulations, currency risks, and cross-border payment practices. Technology is increasingly central to this role. Credit managers are often tasked with implementing or managing credit management software, ERP systems, or automated scoring tools. They use dashboards and analytics platforms to track key performance indicators, KPIs, such as days sales outstanding, DSO, bad debt ratio, and collection effectiveness index, CEI. These tools improve decision-making and enhance operational efficiency. Midway through these operations, it becomes evident that the job description of a credit manager extends far beyond simple approvals or denials. It encompasses a strategic vision of credit risk management, policy enforcement, client communication, and data-driven analysis that supports sustainable business growth. Skills and qualities required for success. To be effective in this role, a credit manager must possess a robust set of technical and interpersonal skills. Financial literacy is paramount. Credit managers must be able to read balance sheets, income statements, and cash flow reports to gauge a company's ability to repay. A deep understanding of accounting principles, debt ratios, and liquidity measures enables them to make sound decisions. Analytical thinking is equally critical. Credit managers must process large volumes of data, identify risk patterns, and foresee potential defaults. The ability to interpret trends and adjust strategies accordingly can protect the organization from significant losses. Familiarity with credit scoring models and credit bureau reports further enhances decision-making accuracy. Communication is a vital skill. Credit managers must explain credit decisions to clients diplomatically while maintaining firmness in enforcing company policies. Internally, they communicate regularly with sales, legal, and finance departments, ensuring that everyone is aligned on credit limits, collection timelines, and risk exposure. Negotiation skills are also crucial. Credit managers often need to negotiate payment terms with clients, set up installment plans, or resolve disputes. These interactions require tact, fairness, and clarity to maintain customer relationships without compromising the company's interests. Technological competence is increasingly important. Proficiency in software like SAP, Oracle, Microsoft Dynamics, or credit-specific tools like HighRadius, Dun & Bradstreet, or CreditSafe helps credit managers manage data efficiently. Many organizations now rely on automated workflows, AI-based scoring, and cloud-based dashboards, which demand digital fluency. Time management and organizational skills are essential in handling multiple accounts, deadlines, and reports. Credit managers must prioritize tasks effectively, respond to urgent credit reviews, and follow up promptly on overdue invoices. Finally, ethical judgment and integrity are non-negotiable. A credit manager often deals with confidential financial information and must uphold privacy, fairness, and transparency in all dealings. Ethical conduct builds trust, both within the company and with external clients. Work environment and industry dynamics. Credit managers typically work in corporate offices or financial institutions. The role involves a mix of desk work, meetings, and occasional travel, especially when reviewing major accounts or attending industry conferences. While the environment is generally structured, the pace can vary depending on business cycles, seasonal sales, or economic trends. The job can be high pressure at times, particularly during periods of economic downturn, where customer defaults may rise and risk tolerance narrows. Credit managers are often expected to make rapid yet sound judgments under tight timelines, balancing customer relationships with the imperative of protecting company assets. Cross-functional collaboration is a hallmark of the role. Credit managers must coordinate with sales teams eager to close deals, finance departments tracking cash flow, and legal teams handling disputes. Building strong interdepartmental relationships enhances efficiency and ensures a unified approach to risk management. Career prospects are solid. With experience, credit managers can move into more senior roles such as regional credit director, risk management head, or finance controller. Some professionals transition into treasury, compliance, or even CFO roles, leveraging their expertise in financial oversight and operational control. Many employers value certifications such as the Certified Credit Executive, CCE, Credit Business Associate, CBA, or Chartered Financial Analyst, CFA, which add to credibility and open up opportunities for advancement. Formal qualifications in finance, accounting, or economics are typically expected, often accompanied by a bachelor's or master's degree. Globalization has added a new dimension to credit management. Credit managers now deal with multinational clients, diverse regulatory environments, and volatile currency conditions. Understanding international trade finance, Incoterms, and letters of credit is increasingly relevant for those handling cross-border transactions. Conclusion: the job description of a credit manager reveals a multidimensional role that blends finance, strategy, communication, and technology. These professionals are guardians of credit risk, working at the intersection of profitability and prudence. Their actions influence cash flow, customer relationships, and long-term business viability. For those with strong analytical skills, a head for numbers, and a steady hand under pressure, this role offers both challenge and reward. As businesses grow and economies evolve, credit managers will remain central to ensuring that growth is built on a foundation of financial responsibility and informed risk-taking.